So my name is Brice Hoffer, and I'm the head of real estate research and strategy for the DACH region at UBS Asset Management. Of course, the multifamily sector in Europe, like other property sector, experienced a very dynamic capital value growth in the last year, especially due to the low yield environments who put pressure on the cap rate in the market. But going forward, that is said to be for almost all property sector in our view, it is likely that this component of the total performance is getting to lose steam as a driver of the performance, as I said, and the income part will be more and more important in investment in properties going forward. And in this phase of the cycle, the real estate cycle where we are, multifamily is particularly attractive because the income part is typically resilient and not so prone to economic shocks like in other commercial property sector. And that's what is speaking for the resiliency of the sector. Long-term trends, in my view, are mostly affecting the demand side of the equation. So it's basically the demographic. Per se, in most of European countries, we're expecting positive population growth in the coming decades, coming 15 years. But what is important to say, and something that is reinforcing this dynamic, because when you're speaking about demand for residential, we're speaking about the growth of household number primarily. And due to the shrinking average number of person per household in most of European countries, we're expecting even a higher growth in household number than in population growth in the coming years. In this frontier market, the demand or the investor demand for institutional grade products is mostly coming from cross-border. That's something we can see. And in the more established market, it's a bit more diverse, where you have also local players from the institutional industry that are also very established and also a part of cross-border capital. The drivers on the demand side are very long-term in multifamily, which is also nice to analyze and predict in some way. According to our analysis, it's really clear that large city and especially the metropolitan area, the agglomeration, are set to be the hotspot of demand in the coming years. And in our view, so this is where the growth is set to happen. Then now, of course, you have some effects coming from the potential increase of home office activities going forward. So we don't think that people won't go anymore to the office in the core city center going forward. We don't think so, but maybe a bit less often. And this maybe open more opportunities even for the agglomeration area and not the core city centers. So as said, I think the fundamentals are sound. If we look at what happened also in 2020 in terms of rent collection, of course, the property can be utilized, but people still have to pay rent. So rent collection activities remained widely undisrupted last year. So hopefully it's going to be the same. It can be some small disruption somewhere in some case, but it's not the base case at the moment. Demand in agglomeration area and of the large city centers is set to remain sound in our view. And the chronic construction gap that we are now experiencing in Europe since almost a decade won't revert in a very short time. So all that is advocating for some market fundamentals in urban areas and for more rental growth. But keeping in mind also that rental growth can may be capped somehow by the economic condition we have at the moment. Wage growth that is likely to not be very dynamic this year or in the near future. The deep economic disruption that we are experiencing.